Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here at Trading Capital. Jumping into the charts on this September 15th, another down day on Wall Street. And what is very, very important about this specific down day is what has transpired across multiple different sectors. So not only was the S&P 500 down by 1.13%, by clearly seeing a nice down day, but it was a very, very choppy session. And the importance of this closing low is you've now closed on a closing basis lower than any of this support zone. So the big question is, do we see confirmation below this level tomorrow? And if you factor in a secondary confirmation status, this beautiful trend line that we've been watching, this pivot to this pivot to this pivot, you have now tagged it over here. You bounced, you had a 4-day rally right into resistance, and now you've pretty much given back all that rally and then some, and now you're looking to confirm below this yellow trend line. So that is the big level we watch. Do we get a follow through of downside confirmation? If we do get a follow through, the likelihood of us heading down here, basically the probabilities increase substantially that we head down to this level. Now, we're not going to be a straight shot down in there, but there is significant support levels along the way, which we will be trading. You have one here around the 3,800 level, gap fill. You also have another major gap fill down here. And then along with the gap fill that's close by, obviously you'll have the double bottom support. So looking at this chart, this is minor. Maybe you get a 1 to 2 day bounce. This level down here is a little more major. Maybe you get a week's bounce. But ultimately, I do think you break this first level and then you break this second and third level, eventually hitting the low range of this channel. And one of the reasons why this channel is so significant is you had your high, your retrace to basically the center point. You can see that that was support, 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 a bounce all the way up to the high again of this channel, a sell-off all the way down to the low, a rally, your summer rally all the way to a high. And now it should follow the same pattern where you've been ping-ponging back and forth, of course with technical bounces along the way, but inevitably heading to the low range of this channel at some point in time. Now, with that being said, that clearly means there's likely downside ahead for the markets, and that's certainly how we're positioned. But we're going to be very, very strategic and smart in the way and how long we hold on to our short positions, because just like over here and just like over here, we are also going to play the next leg up in the markets when we do get that inevitable technical bounce. So with that understanding in mind, support 1, support 2, support 3, support 4. If we look at the intraday action, it was a very, very wild session for the S&P 500. You can see this is where we opened up, made a little bit of an intraday high. Ever since you put in that beautiful topping tail, the markets have never taken out that high and continuing to make a series of lower highs and lower lows. So that is clearly defining a downtrend. Now, in the event that we start rallying up, we have a clear resistance point over here. That's going to be our trend line that keeps us intact for the potentially, if the markets do catch a little bit of a bounce, where we see the US dollar slightly pull back. But overall, these markets are in trouble. They're starting to break key technical levels, and we're waiting for that confirmation day tomorrow. Now, the critical thing about this is that this week is options X, so we have to take all technical signals with a little bit of a grain of salt. That being said, I still think the global macro trend is more powerful than an options expiration event, but with a quadruple witching happening on Friday, meaning 4 different asset classes expire, there is multi-trillions of dollars on the line, which is very, very lucrative and enough of a motive for institutions to manipulate the price action of stocks and indices in the very short term to where the max pain level will be for the option traders. Now, we don't play options just because it is pretty much a losing market there, especially during this volatile period where spreads are so high. But it's certainly something we have to pay attention to in the grand scheme of things, because when there's 3 to 5 trillion potential changing hands and accounts, that is enough of money to send asset classes and specific stocks in certain directions where people most likely do not expect. So key trend line break, Confirmation day tomorrow. If we get a breakdown tomorrow, then the confirmation is confirmed. If we don't, then technically this support line is still intact, and it means that we could have a bounce even up to fill this gap. Now, it's very unlikely that we head up there in my point of view, but there is still the chance, which is why we have to consider it. If we take a look at the QQQ daily, NASDAQ was down 1.67%. Let me just erase some of these lines as they were my intraday lines. So if we take a look at the QQQ, you have that same support line, which would have been over here, major pivot to major pivot to major pivot, which you've clearly confirmed below. But then if you draw the second trend line that I've been watching, which was this, where you hammered on it once, had your big rally, hammered on again, a little bit of a bounce, and now you're looking to confirm below it tomorrow, just like the S&P. So where do you have next support? Very, very close on the NASDAQ over here, showing that there's relative weakness in the NASDAQ. So the NASDAQ is showing a gap fill just around 287 or so. That's your first little area of support, but considering that you bounced just right above that level, this is not a major or an intermediate level of support. This is a minor level of support. So maybe you get an intraday bounce, but expect the price action to slice through that level more likely than not. Your next big level in the NASDAQ will be this gap fill down here, which will also coincide with close proximity to your downside double bottom level. So I do think we get a technical bounce off this double bottom, but I don't think we're going to be taking out this high. I think that technical bounce will have to keep us in and around this range. So maybe, by the time we get down there in, say, maybe a few weeks, that we get a little bit of a bounce at best case scenario to the top of this trend line. That's best case scenario. Not saying we do get there, but I do think we get a bounce off of this double bottom and maybe best case scenario to that. So we're going to be looking to play kind of a move like that in the indices. And that type of a bounce will likely have to occur with the US dollar pulling back. So US dollar once again having a little bit of a positive day. And the markets and indices were very, very choppy. When the US dollar intraday action was down at the lows, the markets were rallying. And then when it rallied up at the highs, it was basically causing a lot of strain on the markets. But you can clearly see intraday action. This was the big level. And why I was suspicious of these markets was this move early on. You actually had confirmation above this breakout level, and then it failed to hold that level in the larger time frame. But considering that you confirmed, there's always the likelihood that you can start to recapture that level again, as long as you didn't take out the major pivot low, which occurred just after this this high. So which we held this major pivot low, and then you rallied back up and reconfirmed above this breakout channel, which just shows that their likelihood of the US dollar continuing higher, maybe to this next resistance point around 109.86, is very, very likely. We could easily see that. Now, on the longer term basis, if we remove these two lines, you can see that this is a little bit premature. But if we get, 1, 2, 3, 4 more days or so of consolidation, which should coincide with taking us to the Fed meeting. Let me just pull up my calendar. So the Fed meeting is on Wednesday, which would equal 1, 2, 3, 4 more days of consolidation. That would be enough of a bull flag pattern to potentially have a break to the upside. So I think that break is going to come on the back of that Fed meeting. We're either going to see the Fed revert course and be dovish, which will weaken the dollar, or we're going to see the Fed remain hawkish, which is going to send the dollar for its next potentially up leg, taking out this high. Based off of this pattern so far and just this sheer power of this reversal and where interest rates are currently trading, I'm in the camp that the US dollar continues to hold these levels bullishly and then potentially breaks out and at least tests this double top of 110 before having its next pullback to around this 108.69 level. So I think the pullback comes to basically this level over here, but I do think that we see a double top retest at the minimum, if not new highs on the dollar, before it breaks down and starts its next consolidation leg. So the dollar is clearly everything to the markets. The dollar is also crushing oil again. Oil was having a little bit of a bounce, and now it had a massive down day, just reinforcing the sheer weakness in the overall economy. A lot of this came on the back of, poor manufacturing sales across the board. Obviously, China's consumption has waned significantly due to their zero COVID policies. And honestly, with the even on the potential rumors that the White House is buying oil at $80, oil can't even catch a bid and make it to the top of this channel, which just shows to me relative weakness and overall bearishness in the energy sector at this point in time. But the interesting thing, the positive for the energy sector, is that the energy stocks are holding their momentum and holding up a lot better compared to the price of oil. So that is just something interesting to note. If we take a look at natural gas, did we not have an epic short yesterday on natural gas? Basically shorting at these levels over here, around the $9, $9.12 level, buying the KOLD, and natural gas collapsed today, completely having pretty much a failed breakout. There were many bulls hopping on the price action yesterday, thinking we had a short-term breakout above this trend line, and what a fake out it turned to be, completely engulfing this candle, closing lower, just hugging that 50-day moving average, and now starting to form that potential head and shoulders formation, which we have been calling for the last few trading sessions. So we're telegraphing this. We've been providing our members ample notice. If you did not catch this trade with us, then unfortunately that is on you. Now, with a tremendous move, a one-day move of a decline of 8.6%, it put us in the money deeply on our KOLD. You can see that our average here is around 1086, putting us well in the money over that double-digit percentage, which is awesome to see. Now, I was so close, very tempted to take profits on this trade, considering that when the market gives you a beautiful double-digit gain in one day, generally you shouldn't be greedy, but I think I'm going to be a little bit greedy this point in time. We could see a little bit of a technical bounce. It is options expiration, so the price action is so wild across many assets. You have a failed breakout over here with a major reversal. Tomorrow we could see another pop, pretty much negating this reversal. So who knows what price action is, but overall the likelihood of natural gas coming down, I think, is more likelier based off of this chart pattern, the distribution signals, the monthly overbought signals, the overall global markets deteriorating, the recession, or the global markets also getting weaker in the sense of pricing in a recession. So lots of catalysts in my opinion. If we take a look at what else transpired today, gold is so interesting. Gold was taken to the woodshed today, and it was brought new lows. Basically, you lost this pivot. Now you haven't confirmed below this pivot, so that's going to be the real kicker tomorrow. If we confirm below this pivot, then we're likely seeing the low 1600s to the bottom of this range. And that would be a gift off an opportunity to buy if gold went down to those levels. And will I buy? Absolutely. We bought a little bit today just to accumulate a little bit more gold, increase our exposure. I love accumulating gold at these levels. I'm going to show you a larger time frame on gold. And one of the reasons, if you look back historically on gold always has these harsh price action events in the face of options expirations. And one of the reasons why is because the precious metals market, no matter if you're a gold bull or a gold bear, the precious metals market is notorious for manipulation and spoofing. I mean, the SEC has handed out spoofing fines to CIBC, JP Morgan, the various amounts of the big banks. And so the evidence is clear that it's not a conspiracy theory. The evidence is clear that the precious metals gets manipulated. And one of the reasons why is you have millions of ounces of paper contracts either dumped on the open market. Basically what happened here is millions of ounces were dumped on the open market, completely crushing the spot price of gold, which obviously allows the big banks to start accumulating the physical, which is what JP Morgan does on the back end, and many of the other banks. They crush the price, they dump many futures paper contracts on the market to lower the physical price, and then they go and start buying the actual physical metal itself. So that is what is happening right now. Banks are actually still accumulating. They're massive net buyers. So that, inevitably you will get the technical bounce. But this is certainly shaking out investors. Many people thought that gold had its bottom over here with this beautiful reversal signal. Now technically this daily bottoming tail is intact because you have not closed below and confirmed. So tomorrow is a pivotal day for the metals, but I'm actually hoping that gold maybe goes a little bit lower. That gives us an even better price to accumulate more, because at these levels, my mouth is salivating, especially when you look on, let me just remove this downsloping parallel channel. Let me just throw on the monthly chart for us. So if we look at the monthly chart is so fascinating to me. If we simply take a look, this is a beautiful 1, 2, 3, 4, 5, 6 months down in a row. It's very rare to see an asset class like gold drop 6 months in a row. Yes, you had a technical bounce over here, but it's been straight 6 consecutive months of downside. These are the opportunities that as a technical trader we salivate and have to be ready to start accumulating. That's certainly what we're doing. And the beautiful thing is you're approaching this 50-day monthly moving average, which is going to be an impeccable amount of support. The fact that you're still holding that monthly bullish bull flag formation, this is actually a very bullish pattern, just digesting this whole move. And this is a very balanced up move, and now it's becoming a very balanced down move. You're starting to shake out all of the weak hands that accumulated gold in here, expecting a breakout. They're all being dumped out. The stops are being run, considering you're now trading at the key level that broke your triple bottom over here. So the fact that gold is at 6 months in downside, approaching a moving average, approaching support. If we look back historically, this is where things get interesting. If we look back historically, where gold had 6 down months in a row, you had it here in 2018, 1, 2, 3, 4, 5, 6. Look what happened after. A massive move in gold. You had one of the biggest rallies in gold from almost $1,200, or actually $1,157, all the way to $2,000. That was almost a 100% rally in gold. So 6 months over here, look what we've just did, 6 months. And considering this is a 6 month time count off of a major long-term bull flag pattern, is just making me salivate. So we have this time in 2018 where we had 6 months. Then the only other time in gold's technical price charting history is going all the way back to the 70s. 76, you had 1, 2, 3, 4, 5, 6 down months in a row. And what the crazy part of this environment is, this is when inflation started to run rampant. 6 months in a row led to gold, one of gold's greatest rallies ever in its price history. A 773% rally in essentially 4 years. That's about 125% or more each year in the price action of gold. Is that not a powerful rally or what? So the signals on a technical basis, which is why we're starting to accumulate, we bought more today, is priceless. I mean, these are the levels where you have to take your shots at and not get sucked into the fear of what gold is likely going to continue lower. This is still a tremendous asset class, much safer than the overall stock market. Obviously, with the dollar soaring, it's going to continue to put pressure. So the dollar will have to soften as gold starts to rally. So that's going to be the key thing. But these are an epic gift from the gold gods that we have to start capitalizing on. And the beautiful thing about gold, and why I think this is just a short-term manipulation, if you look at silver, silver's actually still holding a beautiful bull flag consolidation. Yes, it was down today on the back of gold, but holding up relatively much better. If you look at where silver is still holding its low, whereas gold made a new low. So that is relative strength. And if anyone knows anything about past historic precious metals bull markets, and why I'm getting so excited for it, is that silver typically has the second leg in a bull market. There's 2 stages. The first leg is the gold bull. The second leg is the silver bull. What I believe we're going to be entering is the silver bull market. And if you look at the strength in the solar companies, they've been getting so big. And what does solar require most of? They require silver. So if there's any correlation there with their actual massive run-up in solar companies, those solar companies getting bigger and bigger will require more silver demand. So with them requiring more silver demand, I believe they're going to be propping up this price and putting the fire under it that will give this silver the massive breakout to the upside that many investors aren't thinking of, just due to the fact that silver is an industrial metal, and if it's an industrial metal with the economy weakening, technically that has a headwind. But if you peel back the layers and you analyze how oversold silver is, you look at the long-term pattern, extremely bullish at support. I think as soon as gold puts in that bottom and starts to rip up, silver is going to really start to outshine and close in that gold-silver ratio, as it historically has a massive run at the second stage of the precious metals bull market. So lots of things, lots of exciting things to continue to keep our eye on. If we look at the US 2-year yield, once again, we prepared all of you, our members, for a breakout in the interest rates. And interest rates have been on a tear. What are you on right now? You're on a 1, 2, 3, 4, 5, 6 days of upside in the US 2-year. So anyone that doesn't understand the US 2-year, this is where the federal fund rate has to get to. So this means that the bond market is implying the federal fund rate has to continue to raise their Fed fund rate to this 3.85% level. Or it either means that this bond level has to collapse, these yields have to collapse to tighten in the range of the Fed fund rate. When the Federal Reserve raises interest rates by 0.75% on the 21st, some people are pricing in a full percentage point hike. But if they only raise by 0.75%, that takes the average to 3.25%, which puts you roughly around this level over here. So that's roughly where the Fed fund rate is in green. I'll put that trend line in green. And this is where the bond market is pricing the Fed that they have to get to. So a substantial net difference in the actual rate. We're talking about a 16% difference. So in the event that the Fed starts to come dovish, these rates would start to collapse lower, but that means inflation was likely to remain stickier. So this is why the Fed has to continue to raise rates aggressively, and this is why the bond market is pricing in a more aggressive Fed. You can specifically see with this powerful move. So incredible move in rates. If we flip to a long-term chart, the last time we were trading at this level was all the way here in Jan of 2008. And the interesting thing is that we've now hit this level. This is the exact level where the bond market gave the signal to the equity market and overall economy that a housing crash or an inevitable black swan event was likely to occur. As soon as you broke this trend line here, this was your signal to go short the equities and start offloading longs, because interest rates fell sharply, which inevitably led you to the housing bust. The housing started showing cracks over here based off of yields and rates, and this is the housing bust that occurred. So a massive signals. We're now trading at the level which signified the breakdown in the 07, 08, 09 housing GFC crisis. So just interesting tidbits of information, just to note that. And considering that valuations and debt levels are substantially higher is really concerning to me from a fundamental analysis picture. You had many stocks that got crushed today. Adobe, massive down day. We caught that, so congratulations. We did bank a couple winners with you guys in the day trade room that everyone could have caught as well. So a beautiful job there. But once again, we're starting to see weakness occurring in the markets. If we even look at, Apple, let's for instance take a look at Apple's chart. It might be a little messy. Apple significance closing at a new low, basically negating all of this support over here. Technical confirmation awaits. We are short Apple, so that is good to see. I still think Apple heads to the low range of this channel, and then inevitably I think Apple tests this double bottom. Of course, we're going to have bounces, but my long-term target for Apple that I have calculated, and just to put into perspective, this is your pre-COVID high at 80 bucks. So considering that that is the massive level where QE basically started ramping up. QE got us out of this bottom, back into the trend, and then that extra 120 billion a month with low interest rates just fueled one of the most epic rallies in Apple. And considering on Apple, we're still trading in the upper ranges, we're still in this massive upper range, shows that there's a lot of downside in Apple. And once the institutions realize that, this inflation isn't going away, the economy's slipping into recession, I think worst case scenario, we head down to this massive technical gap fill. It is around 94, 95 bucks. So that is my Apple call, and you can imagine how painful that would mean for the overall indices, considering Apple carries one of the biggest weightings in the S&P 500. That would imply another 37% down, on Apple from these levels. That's an astonishing fall, which I think people say you're crazy, but I think that can absolutely happen. Absolutely happen. So massive, massive down day, or not really a massive down day, but a really solidifying, important down day for a variety of stocks as they're breaking key support levels and looking to confirm that technical downtrend. So congrats again. Let's continue to analyze things from an objective basis, and I think we'll be more than fine in this market. I believe, at least my swing trading account here at Trading Capital hit a new closing day high, not a new all-time high, intraday high, but a new closing high. So we're chugging along once again in the right direction, and it's just a beautiful, beautiful thing to see and continue to profit as we have been in 2022. So that's it for today's analysis. Hope everybody has a fantastic rest